Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds. Missed last week's video, sorry. I'm in trouble with the marketing team, but I completely forgot about it. But I'm joined this week by Gareth Brown, who works with us on the International Fund. Hi Gareth, how are you?
Hi Steve, hi everyone.
I wanted to touch today on a topic that's been all over my Twitter feed. I don't know about yours, and starting to turn up in all of the newspapers as well. But that's Robinhood and his impact on the stock market. Can you just give us a quick explanation about what people are talking about?
Did you say his impact on the stock market? Yeah. Right, we're going with the Sherwood Forest analogies, I see. So Robinhood is an app that's been around, that's been around for about 5 years now, but it's really grown in popularity the last little while. And it's an app that allows you to trade stocks, currencies, cryptocurrencies, options, all sorts of stuff, commission free. And so you can go and buy your 10 shares of whatever and not pay a commission. And it's been growing extremely rapidly. They've got 13 million users, I believe. They've had growth of more than 3 million users over the course of this calendar year alone. And it's becoming a real force in the market. There's a whole bunch of idiots on YouTube, like recording videos of themselves day trading using their Robinhood accounts. And it's becoming a real subculture and something that's somehow reminiscent of things that were going on 20 years ago in the tech boom.
Yeah, I think because it is free, because it's an app, it's very millennial, I guess, in the way that people use the product, and because of Twitter and YouTube and all of these people at least telling the world that they're making fortunes and trading for free, it's attracted a real following amongst new young investors, I would say, and a lot of criticism of some of the slower, older investors. Warren Buffett in particular, I think, has been a prime target of some of these people. He knows nothing, and yeah.
We'll move on.
Well, just when you say 20 years ago, I think there's a lot of trading going on of stock prices that are just going up without any reference whatsoever to the underlying value of what's being traded. And it is very reminiscent in that regard, at least, of the tech bubble. And you're seeing these stories about people getting very, very rich, particularly out of this last meltdown. And there's, I think, a lot of concern there about some of the marketing and ability for people to lose money in that space. But it is, and you already touched on this, it is also affecting the real market. And some of the hunting ground that we like to look in, small cap stocks, businesses that are underappreciated, we are seeing them affected by this phenomenon.
Yeah, that's right. So we're profiting from that. Some of the stocks that we own have been skyrocketing. We've been doing our best to harvest gains as we can. And it's kind of, it is a concern that it's sort of impacting some of the hunting grounds for us. So I'm sure you've gone to a currency booth when you're in Trafalgar Square or somewhere else overseas and thought, I might just change a few dollars and get some local currency. And if you ever notice it, they're extremely wide spreads. They're making these huge margins on you, but they've got this big sign sitting there saying no commission. And this is like a modern version of that. Robinhood is commission free. It is not free. So the ways they make money that I'm aware of, any cash balance that you have, they harvest the interest from. So they take your money, they lend it out to counterparties, they keep the interest. They take your long position stocks, they lend them out to short sellers. They take the fee from that as well. Now, those two things you might want to think of them as a source of return-free risk. Like things can happen when your money's lent out or when your stock is lent out, and you're not getting any compensation for it. So that's a concern, and it's quite a binary concern. But I think that's sort of that's really entry level Robinhooding. The chief bit here is that they trade through these dark pools and they trade through alternative brokerage systems. So rather than going on exchanges, they'll tell you it's because they get cheaper execution, and there may be some truth to that, but they also get rebates. So your order flow is being sent to people like Citadel Securities, Virtu, other high frequency trading firms, and they are, let's say, front running you very regularly, and that's why they pay the rebates back to Robinhood. Now,
I think some people would argue you can trade through a traditional broker pay a commission and still get skimmed by the algorithms and the front runners. So what's worse about this?
And it's true, and that is their best defense. I think it's worth noting here that they've said in a blog that the founders have said that exact same defense in their blog, which is legitimate. Understand the founders of this firm come from the high frequency world. They started off by trying to build a high frequency trading firm, and then they started building systems for other firms. So their whole, it may be that they're doing some good in the world, but they are actually from that world of high frequency trading. And I have a feeling that their average Robinhood account holder is a bigger sucker for that kind of stuff than most brokerage account holders, especially when you're trying to day trade in and out of things. You're going to get skimmed very regularly, and it's going to be quite a meaningful cost over time.
Yeah, we live in a world where these phenomenon happen faster than they've ever happened faster, and I think on a more global scale than they've ever happened before. And this one has certainly, in terms of my reading, come from almost nowhere and become very mainstream very quickly. And we're seeing that very across different industries and different spaces because of the internet as an enabler of these things globally. But you touched earlier on it impacting some of our stocks. I mean, how do you actually think about it in terms of our own portfolio? I don't think anyone out there at the moment is going to be complaining about the returns we're posting for the year, because they've been very good. But even with me, there's some stocks here that I'd really like to own for a very long time, and getting all of that gain in a short period of time, we're almost forced to sell some of these stocks, and it's not necessarily ideal for us.
Well, why don't you talk about Spotify? We bought Spotify. We think everything's falling into place. We're seeing some pieces of the puzzle definitely falling into place, but we're still waiting for all the evidence that suggests this stock's worth twice what we paid for it. It started moving in that direction very, very hard based on, what was it that Harvey said the other day to you?
Well, we've had Kim Kardashian. They've signed up a Kim Kardashian podcast, and the latest one yesterday was a partnership with DC Comics to produce podcasts as well. And the share price, well, it's up 50% since we purchased it. It's probably up $5 or $6 billion in market cap over the past week on the basis of these couple of podcasts. And we sold a little bit more of the stock last night. And Harvey said to me this morning, I really want to own this stock long term. I'd be happy continuing to hold it if this price move was on the basis of the margin thesis that we have playing out. But we don't really have any more evidence that is going to play out. What we've got is a Kim Kardashian podcast and the share price up 50%. So I think it makes it really hard for us, because there is still all of that uncertainty about how profitable this business is going to be. It is very hard for us to hold that in the same proportion that we could hold it at 50% down. Yeah.
I mean, as long as we find places to recycle into, that's fine. But that's the question mark. As the market gets frothy, it's harder and harder to do that. I think maybe there's some positives and negatives to this sort of back to day trading type world. So one, we're benefiting on some of the stocks we own, getting caught up in that silliness and maybe getting fuller and fairer prices quicker than we might otherwise. It sort of, on the negative side, it damages the immediate opportunity set. But I think longer term, how do I put this? If you think about the market as there's the market return, and we're aiming to be the smart money that out earns the market, there needs to be a pool of dumb money that under earns the market, or else the whole thing doesn't work, right? And for 20 years, I've sat there and lamented. I've gotten better and better as an investor, but the world's gotten harder and harder. And part of the reason being is that all the dentists of the world that used to open, trading accounts and punt on crazy stuff, they've started getting smarter. They've started buying index funds and ETFs, and the dumb money's moved out of the pool. And this is like a glimmer of hope for us. There's a bigger pool of dumb money than I thought, and a bigger pool than there was 12 months ago. And it's got to be opportunities coming from that.
Yeah, I think that's true, and I think that's true of the past 12 months. I know that it is stressful, and I know it's been gut wrenching going through what we've been through over the past 6 months as this coronavirus thing has hit, but we need volatility. Our whole investment strategy is taking advantage of volatility. And I think as a client of ours, you should really look at that and say, well, this has been a great year for us as an investment team, because it has enabled us to put some of those advantages that we have to work. And you don't want it to go away. I know people want prices to go up and they want to feel rich, but for us to actually add value, we need that volatility. And this is just another element. There's obviously been some far bigger elements to that volatility over the past year, but I think this type of activity is also going to create volatility on the upside and the downside, and that is long-term helpful. All right, I'll be in trouble for running over time here again. They tell me that Twitter and YouTube has short attention spans, so we need to keep these short, but that's been very interesting, Gareth. Thanks for your time, and we'll see you again soon.
Yeah, bro.